Let's move on now and go to Chris Conway. He's Head of Research and Trading at the Australian Stock Report. He joins us live now from our Melbourne studio for more on the market moves today. Great to have your company on the show today, Chris. Just discussing that retail sales number and I guess some of the other numbers we've seen out in the last few days, the GDP, the RBA statement with rates on hold. Just what sort of mood has that given the Australian share market and investors that you're speaking with?
Look, I think the mood certainly has shifted. It shifted leading into the, post the RBA deciding not to back up the February rate cut with another cut. That was followed up by the GDP numbers, which came out weaker than what the market was hoping for, but are basically right on what the RBA was expecting. So unfortunately, that doesn't feed into the rate cut formula. But retail sales numbers today, right on the money, so that provides a bit of support. But look, then again, retail sales, they make up only about 4% of the Australian economy. It's not like in the US where consumer spending makes up 70% of the economy. So again, we don't think it's likely to have a significant impact on what the RBA does moving forward.
Yeah, and no impact on markets today, really. It's still down 0.4%, 5,881 in terms of the level. You know, we've been speaking so much on the show about getting to 6,000, more from a psychological perspective than anything, but we got just a few points away from it the other day. Now we're sort of treading further and further away from it. What do you make of valuations at the moment? I mean, do things start to get interesting at these levels to you?
Yeah, look, absolutely. We think valuations are probably stretched. Over the last 10 years, the market traditionally trades on a PE of around 13.5 forward times. At the moment, that's pushing up towards 16.5 times. So yeah, look, everyone who was chasing the yield has obviously taken a step back, taken a look at where valuations are. They do appear stretched, so we might see a bit of a deeper pullback. We don't think the market's heading to 5,500 though. Probably around 5,800 could be a realistic probability. But then again, it is a low-rate environment that we're in at the moment. The expectation is that the RBA will still cut, probably, as your previous guest said, in April or May. So lower for longer seems to be the theme there. And investors just need to pick their spots. Now is probably not the time to be buying because the market is coming off a little bit, but there will be that yield story that remains in focus in the near term.
So with a lower for longer interest rate sort of guide going forward, why aren't we seeing consumers spend more? Do you expect to see, I mean, it's obviously a lagging indicator when you look at those retail sales numbers from January before any of the rate cuts have been sort of priced in. But what do you expect to see in the discretionary space going forward?
Look, that should improve. Putting the retail numbers today into context, over the last year the run rate for retail sales has been about a 5% growth. Now that's a level not seen since around 2008. So in context, retail sales numbers and consumer spending is actually quite strong. Again, as your previous guest said, with the lower oil prices as well, that should feed into it. Lagging indicator again, as you said. So we expect it to improve over the medium term, probably not in the near term.
Now, I know you're looking at Premier Investments quite closely. It hasn't reported yet. It reports on the 24th of March. What do you make of this one? What are you expecting? Are you buying it into the result?
Yeah, look, we really like Premier Investments. It's a company that was the control of which was taken by Mark McGuinness around 4 years ago, coming over from DJ's. He's embarked upon an optimisation strategy for the company, looking at salaries and rents. He's really helped improve the numbers across the board. JJ's, for example, one of their brands, the optimisation was completed recently. They've had 2 positive like-for-like sales prints. The other brand that is really a key, or we think is a key growth engine for Premier is Smiggles, which is children's stationery, believe it or not. They've just launched in the UK. They've got 8 stores there at the moment. They're looking to grow that to about 200 over the longer term, and we expect that will make up around $200 million of their annual sales. So we really like this stock. We think the market has mispriced this stock on a number of occasions leading into results. The expectations out there, or the ratings out there from a lot of brokers is a neutral. We have a buy rating on it. We think that will surprise to the upside, and the longer term growth story on the back of the Smiggle brand we really like.
Why is the market consistently getting this one wrong, in your view?
That's a really good question. It's just a stock that's genuinely been unloved by investors. We haven't been able to ascertain any really strong reasons why. Probably because other retailers like JB Hi-Fi, Harvey Norman, they're the ones that take up the headlines. But we really like Premier, we really like the story, we really like their growth prospects, and we think it's time that the stock was re-rated, and we think it will move higher.
All right, we might leave it there, Chris. Thanks so much for joining us on the show today.
Thanks very much, Ingrid.
Chris Conway there out of our Melbourne studio.